Okay, so thank you again for joining for the last part. I'm just going to pick up a little bit on where we left off last time, part three, which was all about taxes and how to save on your taxes, right? Um, and Corey actually asked me a couple of good questions. Um, one of them being, okay, and I think, was it Ganette's husband or somebody else asked me, what can we do as W-2 employees to reduce our taxes, right? And where can we get the deductions? You guys remember the slide? Let me scroll all the way back here, right? So remember, green is no tax, red is tax, right? So you want to maximize your green space as much as you can, right? So during your contribution phase, your growth phase, and your withdrawal phase. And for as W-2 employees, the government basically gives you all these traditional accounts that we talk about: 401k, 403b, 457. You have Roth IRAs, 529s, and then of course HSA is the only real triple tax-free account. The only other way to avoid taxes beyond those accounts, honestly, is real estate has some tax benefits, but usually it's not. There's no tax deduction. There's there's I'm sorry. There's no tax deduction on the contributions. So your post-tax income will be used to purchase or invest in real estate, but there are creative ways to uh, depreciate and write off any gains you make in real estate. So that's the tax code favors real estate investors. And actually, with you know uh, Trump, when he passed his bill, he actually made that even more lucrative, obviously because he's in real estate. And the other thing is to start a business, right? So small business owners get lots of tax breaks and deductions. You can even, as I talked about previously, you can open a solo 401k, and you can take off. You can contribute quite a lot of your pre-tax income into these vehicles as well. So, you could be working a W-2 job and have like, some kind of side gig or something like that if you're so inclined. But that's really it. That's the only other ways to save on taxes beyond sort of the traditional accounts. So, since this is for now the last lecture in the series, I just wanted to do a little mini recap of what we talked about. So part one, we talked about financial risk management, right? So your only real financial asset at this point, at this stage in your career and your lives, for most of you, is your ability to earn a lot of money, right? You don't really have a high net worth. Some of you are worth less than zero with all your debts that you have, right? And so part one was, how do we secure this very important asset, which is our long career, our long financial career of the ability to earn money? And that was mainly, we talked about insurances, right? So disability insurance, then as your net worth grows, the various liability insurances to protect your net worth against like catastrophic losses, um, and starting to create an emergency fund if you do have some event, right? So that was all risk management and creating that solid foundation. Part two, we talked about cash flows and creating a budget, um, and as well as debt management and balancing debt versus savings. And really, I spent a lot of time talking about creating that savings habit, right? That's really the goal. And um, we talked about looking at savings versus rate of return in the beginning when you don't have much capital. The rate of return is honestly meaningless because you need, you know, more money makes more money, right? If you don't have too much money, it doesn't matter, even if you're getting a really high rate of return. So focus on how do I increase my savings rate in your early stages of your financial career. And then money and happiness, we talked a little bit about behavior control and like, how do we um, live on that spectrum of, ultra frugal versus spending paycheck to paycheck. You can be somewhere in the middle and save, be relatively frugal, and spend your money on things that will increase your happiness as opposed to, what you the glitzy stuff, the things, the stuff that you think will make you happy, but doesn't really, and backed by research, right? So what were those things that make you really happy? Being able to buy your own time, which is really our only finite resource, autonomy, experiences with uh, family, others. And then lastly is stuff, right? So I'm not going to say that you don't ever want to buy anything, any stuff, but that should be the lowest priority. Part three, we spent a lot of time talking about taxes, and how to structure your financial accounts so that you minimize the amount of taxes that you end up paying during the contribution phase, during your earning period, as well as taxes that you'll end up paying during retirement as well, right? So we spent all that time talking about that. Now, if you've made it this far, you've laid your foundation of risk management. You've created a great budget. You've made your savings automatic so that it comes out of your paycheck, just like your taxes come out of your paycheck. Um, you are being relatively frugal. You opened all the right accounts so that you are maximizing your tax benefits, right? And so now you have this huge lump sum of money just sitting there. And you're like, okay, I'm doing all the groundwork. What the heck do I invest in now, right? And that's what this part is going to be about. This is when I say I'm going to give a financial planning talk. This is what people think I'm going to talk about, like from the very first slide, which is what are the basic investment concepts? How do I construct a portfolio? And lastly, I'll talk about, hiring an advisor, right? So you have this lump sum of money and you're thinking, well, what do I do with it? How do I invest it so that it grows appropriately, right? So this shows you how dated my slide is, right? So do I just open a Fidelity account and just buy a whole bunch of Apple stock, right? I should have GME, crypto, what else? What's the new hotness? Tesla, right? So I should just have those stocks on here. And of course, I'm being facetious. That's not a great way to go about investing, right? So, those of you who are chasing, Corey, I'm going to pick on you again, right? So, your options and dabbling in day trading, that kind of stuff, right? It's fun to do, but it's not going to build you that financial security and that financial foundation that you want, right? And why would investing in, let's say, you put it all in Tesla or Apple, why would this be a bad idea? Because let's say, next month there's a report that comes out and it says that, oh, iPhones cause cancer. Guess what the value of Apple stock is going to be, right? So there's huge amount of risk when you start gambling and, sort of trying to pick winners. And we'll talk about how we manage that risk. So I call this lecture the very basic investment basics, right? Because I'm like literally scratching the surface of investing and portfolio construction. There's, people make entire careers out of constructing portfolios. And so we're going to talk about risk assessment, particularly your own risk assessment, um, asset allocation, what kind of assets to buy in your portfolio, expense minimization, how do we minimize a lot of those fees that these assets will have, tax minimization. We already talked a bit about the impact of taxes on growth, and finally behavior control, right? So behavior control is really important, and I'm not just talking about, okay, what stock do I pick, but also if there's a bear market like last year during the COVID, the peak of the first wave, the stock market dropped by I think 30% or something like that, right? And our human tendency is to um, sell when things are crashing because you're afraid you're going to lose more, and then people want to buy when things are going up like crazy because they're afraid of missing out, or FOMO, right? Fear of missing out. So that's why having an appropriate plan ahead of time will help you weather a lot of the craziness that you'll see in the market. So a couple more books if you really want to go down this rabbit hole of, how do what's the ideal way of investing, right? And these are some sort of really popular foundational books. And I'm going to save you some time. They're somewhat interesting if you are really into finances like I am. But for those of you who aren't and just want to get to the point, I'll save you time and let you know what they all say. Basically, all of these books say we've studied and studied and studied lots of different investing strategies. And what we've seen is that it's almost impossible to beat the market on a consistent basis if you're investing in equities and stocks. And I don't know if you guys know who Jack Bogle is. Jack Bogle was I think he passed away last year at the age of 80 something. And he was the founder of Vanguard. So I'm sure all of you have heard of Vanguard funds, right? And uh, the equities markets were this place where people would kind of just prey on investors, and they'd have lots of fees, and they would, whether the stock went up or down, or their investments went up or down, the guys who were running these funds would make a killing because they were charging 1, 2, 3% in active management fees because they promised that they would make you a ton of money. And Jack Bogle basically said, look, this is ridiculous. You guys charge all these fees and you don't even beat the stock market, right? So, we'll use the Dow Jones Industrial or the S&P 500 as sort of surrogate for the stock market. And he said, instead of all of these guys basically say, instead of trying to beat the market, instead of chasing that rate of return, realize that there will be volatility, just ride the market and just invest in the market. And don't focus your energy on trying to beat the market. Focus your energy on trying to put more money into it and trying to minimize the amount of expenses that you're paying to all these funds, right? And so Vanguard and Jack Bogle were sort of the pioneer of these low-cost index funds. Index fund investing is very boring, but it's almost a surefire way to financial success. Okay, so that's what all these books basically distill down to. Don't try to beat the market, just ride the market. And traditionally, the stock market, I'll clarify, the US stock market has returned about 7 to 8% per year over the last, 100 years at this point. Risk assessment. So, how risky of an investor are you? Right? If you're putting all of your investments into Bitcoin, you're a very risky investor, right? But there's different types of risk, and risk can be separated into shallow risk and deep risk. So what is shallow risk? Shallow risk is the volatility of an investment, right? Actually, just today, one of the surgeons asked me, "Hey, how's the market doing today?" And I said, "I have no idea." He said, "How can you not know? Why don't you look at the market like every day and figure out, what's happening with the market?" And I said, "Because we know that the market's going to go up and down and up and down. Is it going to change my behavior? Am I going to invest more or invest less uh, based on what the market did today? I don't care about what the market's going to do today or next month or next year or even the next 5 years. My investing horizon is 20, 30, 40 years, right? So right now, a 300 point or 400 point rise or fall will be, when you zoom out over 30 years, is not even a dot on the graph, right? So that's shallow risk. That's volatility. Shallow risk is, you shouldn't worry too much about shallow risk um, because we expect volatility in a lot of these investments. What you have to worry about is deep risk, right? Or permanent loss of value of your investment, right? And there's a couple of deep risks, right? So remember before I said the US stock market returns about 7 to 8% per year uh, over a long time frame. Last year, by the way, it returned, I think, 21%, something like that. But if you look at the Nikkei, right? So the Nikkei is the Japanese stock market in essence, right? The Nikkei peaked at 38,900 on one particular day in 1989. And since then, it has never come back up to that point. In fact, I just looked right before I gave this lecture. the Nikkei is sitting at, I think, 29,800. So that's like a deep risk, right? If you have permanent loss of your investment, right? Now, over time, I'm sure the Japanese investors are still investing through the course of all these dips, ups and downs, and so they still will make money, right? Because remember, if we go back to the second lecture, the guy who was stuffing money away in his mattress and earning 0% rate of return was still coming out ahead of people who were investing very little, right? So this is why savings rate is super important, as I say again. Other deep risks include things like inflation, right? So in the 1980s, inflation like almost got out of control in the United States, right? So if you ask, your parents or some of the older attendings, they'll tell you about how inflation was at 13, 14%, which means that, the things got much more expensive, right? Your dollar became less and less, had less and less worth. Typically, inflation over the last 2 decades or so has been sitting around 2 to 3% per year. That means your dollar becomes worth slightly less every year. And so you have to plan for that as well, right? So if you're going to retire in 20 or 30 years, you have to plan for, the fact that there's going to be inflation, and $1 million today is not going to be the same as $1 million 20 years from now, right? It's not the same as $1 million 20 years ago. And when it comes to risk and how much risk you're willing to take in your investments, the goal should be to take just enough risk to have a high probability of meeting your goal in retirement. You don't get rewarded for taking excessive risk, right? Or if you do decide to take excessive risk, then the rate of return better be really high, right? But realize that you might also lose a lot and not meet your goals. So, my philosophy when it comes to risk, right, and how much risk you're willing to take. So if you have a certain goal, let's say you want to reach financial independence in 10 years, 20 years, 30 years, you lay a foundation in your portfolio of a certain amount of risk, and usually that equates to equities versus bonds, and we'll talk about asset allocation in a second. And after you lay that foundation of, okay, there's a 80% or 90% probability with the historical rate of returns that I'm going to reach my target, then you can invest in more risky assets if you want to, right? But you don't have to. If you decide to have a very aggressive a portfolio, a very risky portfolio, realize that you may not reach your target, because that's a possibility as well. Case in point, look at the Nikkei, right? Does this make sense? Any questions about risk assessment?
No.
What's to say that the U.S. stock market won't go the same path as the Japanese stock market? Not that I think it would. I'm just wondering, like, what makes
Yeah,
the US
no,
stock
that's a very good question. So the Nikkei, Japan was their industrial market was going crazy, right? People thought Japan was going to rule the world with how much the Nikkei ran up, right? And so you don't know that the U.S. stock market is going to keep going, giving 7-8%, right? If you look at any investment, there will always be a disclaimer at the bottom. Past performance does not equal guarantee future probability, right? And so how do you protect against that? What would you do, Corey, if you weren't sure?
hedge with options?
Yeah. So we're going to go even riskier. No. So one of the ways you can diversify is to buy international, right? And so there are funds that let you buy international equities, right? In fact, Vanguard has an index fund of international equities minus, or they have a fund that's called the total stock fund, total global stock fund. So that fund seeks to buy every single stock in the whole world, right? So if you have a country that, like, let's say, some of these developing, second world, first world countries, like China and India, right? Their economies are booming, and the US economy, let's say, shrinks, or the European economy shrinks a little bit. Well, if you are invested in globally, then you are hedging, you're protecting yourself against a downturn in the US market. Usually, when one market is doing poorly, the other market is doing well, right? So when the US market, and you can't predict if the US market does poorly, you know, if there's a whole global recession or global depression, you know, that's a really bad time, right? And in 2008, people, that's what everyone's fear was, that it wasn't just the US market, but if globally, if the whole world went into a depression, then there could have been some real tough times. So, but usually that's not the case. If one country is doing better, then it's at the expense of another country. So by diversifying internationally, you're protecting yourself against that risk. So so that leads to the next point about how do you diversify, right? And so here it is, right? So equities are commonly, you know, stocks, which are basically partial shares of a corporation. And if you look at this example portfolio here, you can see, I think here they have domestic stocks, US stocks, 35%, and foreign stocks, 30%, right? So this way you're investing in other markets as well, in case, you know, like say the Chinese companies do very well, or the Indian companies, or, you know, a company in Africa or whatever. So you're trying to diversify by cashing in on other growth opportunities. Real estate is another popular asset that a lot of investors will invest into. There's commodities, things like precious metals, oil, uh, orange juice, right? How many of you seen Trading Places? It's an old movie. I'm dating myself. I'm sorry. Sometimes I throw out these movies and the residents just stare back at me like, you know, and I feel old. But in Trading Places, they're trading on frozen orange juice futures. And the way to decrease your risk is to diversify, right? You can be as diversified as you want, or you can have, you know, you could put it all into just US stocks. You could put it all into foreign stocks, right? But the more diversified you are, you know, your rate of return probably won't be as high. You're not going to hit um, that one market that goes crazy. Like let's say last year, you know, the US market went 20%. And the bonds did very poorly, right? Because interest rates are so low. But by diversifying, you're having a um, a solid floor. You're having a pretty predictable kind of rate of return. Does that make sense? And you're protecting against one market crashing, right? So if you put it all in Tesla stock, last year it was going up like crazy, but now, as you can see, it's coming way down again. And that's, I mean, some of that's volatility, but that's how you protect against that deep risk that I talked about, diversification. And so if you have a conservative allocation, in this case, you know, this is a pretty conservative allocation. Might be like a retiree's asset allocation. They have only 20% equities, 50% bonds, 30% cash, right? And you can see that the probability of hitting your goals is much higher, right? The range of possible outcomes is much narrower, so you're probably going to land in that outcome, right? Versus a very aggressive portfolio where you have mostly equities, right? The range of possibilities is much wider. You could end up at the bottom or you could end up at the top, right? So the more risk you take on, usually, you know, you will tend to do better, but there's a possibility that you'll actually do worse, and you could potentially lose. You might not reach that goal that you wanted to hit. Whereas if you have a conservative allocation, you're more likely to hit that goal. Does this make sense? Okay. Expense minimization, right? So if you guys remember back to the second lecture, we talked about how taxes compound, right? And I think we're going to talk about taxes again. But not only do taxes compound, but expenses compound as well, too, right? So if you are paying an actively managed index fund that has a 1 or 2% expense ratio. So, these funds will have what they call expense ratios, which are basically the cost that they pass on to the investor of running this fund, right? So an actively managed fund, there's somebody doing all this research and trying to buy the next hot thing, right? And so they got to pay all the analysts. It costs money to do that. They got to make all the transactions. That costs money. So the expenses add up. Versus a passively managed index fund, which again, Jack Bogle from Vanguard sort of pioneered, said, you know what, we're just going to ride along the S&P 500 or um, the Dow Jones or the NASDAQ indices. Or, in fact, why stop there? Why not just buy every single stock that's sold in the United States, right? And we're going to track that. Or why stop even there? Let's buy every single stock that's sold in the whole world. And because we're not actively trading, we're not making huge transactions all the time, we don't have that much fees. We're going to lower our fees so that you can get the market return with as minimal fees as possible, right? In fact, these big companies like Vanguard, Fidelity, um, they all kind of got into a war over fees once people started realizing this. As more and more people like myself are lecturing, talking, blogging about this stuff, about fees, they realized that there's a whole group of investors who only want low fees. So I think Fidelity was the first to, they introduced an index fund that had zero fees, so a 0% expense ratio, which obviously is as low as you can get, right? So you can ride the whole US total stock market with zero expenses. And why is this a big deal, right? So remember, if we talked about how if you have um, taxes, well, the same like expenses, over time, 0.5%, 1%, 2% doesn't seem like a huge amount. But if your rate of return is 7 or 8% over 30 years and you're paying 1% in expenses, then now your rate of return is actually 6%. So you're compounding every year at a rate of 6% versus 7%, right? And how big of a difference does this make, right? So they graph the exponential function all the way out to 50 years, but you see at 3% versus 0.5%, right? With the exact same investments, with the exact same rate of returns, you see it's a difference of like almost like $1 million right there, right? In this example that they have. So fees are a big deal. You want to try and minimize the fees as much as you can. Same with taxes, right? So tax efficient allocation. So there are investments in your asset allocation that will generate more taxes than others, right? So there are dividend paying equities. And we had talked about how dividends will be taxed if they're qualified versus non-qualified, how they could be taxed at your marginal tax rate. Being high income earners, you all are going to be in a high marginal tax rate. So if you hold, let's say, the dividend stocks in your taxable brokerage account, right, because you are all super savers and you're going to be saving um, lots of money, so you have to use a taxable brokerage account because the government restricts your ability to invest in green accounts, right? Then you're going to actually have what they call tax drag, right? Because you got to pay taxes on those gains, on those dividends. If you are an active trader, right? If you, Corey, you buy that option and you're like, yes, I made like $1,000 on, this trade I made this morning. Well, guess what? If you are an attending in the highest marginal tax bracket, you didn't make $1,000. You got to pay, your 40% single living in Manhattan, right, Corey? 40% tax bracket, right? So it's not that high. It'll be 37%. So, okay, almost that high. So you didn't actually make that much money, right? Now, if you were doing this in a tax protected account, you can shield that against taxes, right? And so structuring your portfolio, your assets, so where you have the highly taxed assets like fixed income bonds, unless it's a tax protected treasury, right? So there's some tax free treasuries, municipal bonds are an example. Um, these generate lots of taxes. So these fixed income, which you want as part of your diversified portfolio, you want those in tax protected accounts. And if you have tax efficient index funds that don't generate too much dividends, that are, riding along the market and growing, if you buy a stock and you never sell it and it never gives a dividend, guess what? There's no taxable event until you sell it, right? And we had talked about short-term and long-term capital gains. And even if you do sell it, let's say you sell it in retirement and you held it for 20 years, and you're in a low tax bracket because you don't have any income because you're not working anymore, you might end up paying only, 5 or 10% tax on that versus actively trading now, or having this in a taxable brokerage account and paying 37% now. Does that make sense? So expense minimization and tax minimization is very important. I think this is an aspect of, asset allocation and financial planning that often gets overlooked. And this is where you can kind of really affect your rate of return and your compounding over time, right? So how to hold which assets in your various investing vehicles, right? So for example, my 401k is predominantly all of my fixed income, my bonds that I hold, right? Because those are tax inefficient. But my taxable brokerage account will have a lot of the equity index funds because they don't generate that much tax, right? If I had it so that, and as you guys work and I don't have a slide for that, but as you guys work and, move around from residency to attending or move around jobs, you're going to start to accumulate lots of different accounts. You're going to accumulate 401ks, you're going to accumulate IRAs, you're going to accumulate, your taxable brokerage account. And, when you create your asset allocation of, I want to have 60% equities and 40% fixed income, if you structure your accounts in a way that you're putting the same asset allocation in every single account, that's one way to do it. The problem is you're missing out on tax efficient allocation, right? So you want to structure it so that all of your green accounts will house the very tax inefficient assets like bonds, like dividend paying stocks, for example. And you want to have your tax efficient assets in your taxable brokerage accounts. Does this make sense? I want to make sure that's clear.
Question: would it make sense to do like more risky investments in your tax advantage accounts, like your IRA, since you have a higher probability of making more money? So if you do make more money, will you be taxed less? Does that make sense?
Yeah, I
know.
I understand your question.
It,
so, for example, if you wanted to, a lot of 401ks will have what they call a self-directed brokerage account, where you could day trade in your 401k if you wanted to, right? And so, if you're day trading, you're obviously going to create lots of short-term capital gains. If you're trading in options and stuff like that, then potentially you can generate a huge tax bill. Even like crypto, right? You got to pay tax on any crypto gains that you have, right? So if you're trading in this stuff, there are IRAs and even 401ks that allow you to do these kind of trades in there. You could do that, but what's the point of these tax protected accounts? It's to save for retirement, right? And there's lots of penalties if you take it out early. So if your goal is to make a quick buck and then pull it out and use it, then it's going to be stuck in that account. Does that make sense, Corey?
Yeah. I'm just thinking, like, if you're going to save the same amount of money in your IRA and in your brokerage account, and they're both going to grow like 7%, you do like, or whatever. But then if you plan on doing like, I don't know, like I said, more like higher risk investments with higher short-term gains that are taxed, would you do that in your IRA account versus your brokerage account?
You could.
It's just more risky, right?
It's more risky again, and what's your goal, right? If your goal is to reach a financial target, why take on excessive risk, right? Does that make sense?
Yeah.
But if you wanted to, you could do that, and some people do, right? So they have day trading accounts that are shielded in their 401k, for example, or they have. I mean, there's even like crypto IRAs that you could open, right? It's still subject to the same limits that the IRS allows, the $6,000 per year, but you could do that. Now, obviously, I don't really recommend that, because I think that if you're chasing rate of return, you're kind of missing the point of it, right? And if you have if you have a high enough net worth where those aggressive, if you remember from the very first slide where I had the pyramid, right? And the aggressive investments are all the way at the top, right? So if you are going to day trade and do that kind of stuff, then that's dependent on you having that solid foundation. And I think 401ks, your IRAs, all that stuff is that solid foundation that you don't want to really touch, because if you blow that up, guess what? You're starting to contribute to your retirement accounts and you're at age 30, right? So you're already behind the ball. And if you blow up those accounts, now you're going to be even more behind the ball, right? So now you're going to be stuck in that cycle of potentially seeking even more risky assets because you're even more behind, right? And so then that's a good way to be a 60, 70-year-old attending, still working because you have to, right? So usually if you're going to make those kind of trades, I tend to just do it in my taxable. Okay, so this is the perfect slide for you, Corey. Investing behavior. So, hey, Doc, I got a hot tip for you. I got a great option. I have, hey, how about that Bitcoin, right? And, not to say that you should never invest in any ultra risky assets, right? I do. I have Bitcoin, like I said before. I have, I invest in some various private real estate deals, which are considered risky investments. You have to be an accredited investor to invest in those, right? But I limit it to 5 to 10% of my total portfolio. So that's your gambling portion of your portfolio, right? And why? Because 95% of my portfolio is on a high probability trajectory to get me to financial independence, right? And then if this 5 or 10%, blows up and I hit a home run with some risky asset, well, guess what? That 5%, if it grows to become 20% of your portfolio, then now you can rebalance and lock in those gains, right? And we'll talk about rebalancing in a second. But if this grows to, let's say, 80% of your portfolio, well, now you did very well, right? So you can lock in those gains and shift that money over to the more stable, conservative parts of your portfolio. Does that make sense, Corey? I'm speaking to Corey directly.
Yeah, it makes sense.
And so I'm not saying don't ever invest in a single stock. I mean, I personally don't trade in stocks. I know there's plenty of people out there who trade in stocks. And you're always going to hear the stories of the person who, put in whatever their half of their portfolio into a single tech stock, and now they're multimillionaires, right? Well, guess what? If that company blew up, like the .com era, all those tech companies that crashed, right? Now all that half of your portfolio is gone, and you just extended your goal to financial independence as opposed to shortening that goal, right? The other thing I'll talk about in terms of investing behavior, I'm going to wait until the market goes down and I'm going to cash out on top, right? So people try to time the market. And if you go back to those 4 books that I talk about, they all pretty much say market timing is impossible, right? So you have no idea. People last year, there's a global pandemic. There's entire economies completely shutting down, like stopping manufacturing completely. Like this is unprecedented in history, where basically the entire world stopped, right? And you're like, okay, the stock market was at an all-time high. It's going to go down to 15,000, 10,000, right? There was lots of doomsday um, sayers out there, right? And who would have predicted that a year later, with the economy still kind of struggling and people still being restricted, that we would be approaching that same, actually, I think we exceeded that all-time high, right? So it's impossible to predict this stuff. And so you shouldn't really try to wait for the market to crash or wait for the market to, for the last 6 years now, people have been saying, oh, the market's due for a correction. The market's going to go down. I'm going to take my money out and sit on cash and wait for the market to crash and then buy, right? Because the goal is always to buy low and sell high. The problem is you don't know where the low point is and you don't know where the high point is, right? And that's like trying to do that is going to give you an ulcer, honestly. And as I said, if you zoom out, the market right now is 30,000. There was a huge 30% crash for about 2 months or for about a month last year, right? 20 years from now, if you look at that, it's going to be a tiny little dip like that. Last year it looked like this, right? So don't think, especially at your stage in your career, in your financial career, don't think about the volatility that's happening now. Think about, what does this mean 20 or 30 years from now, right? So how do you avoid market timing? Well, one way to avoid it is to do something called dollar cost averaging, right? So in essence, every month there's some money that gets taken out of my paycheck that goes to my 401k. Now, if the market is up, that money buys a smaller share of the market. If the market is down, it buys a bigger share of that market. Over time, as that shallow volatility happens, I'm buying the average of the market over the course of the year. Does that make sense? So by doing that, you are sort of, when the market is very high, you're buying a smaller piece. So you're not buying high. And when the market is down, with the same amount of money, you're buying a bigger share. So you're buying low, right? So that's dollar cost.
Hi, Dr. Nandigam. This is Dave. I'm Marie.
Hey, Dave. Yeah.
Hi. Do you always buy or rebuy into your index funds that you own?
Yes. Meaning that I have. So let me understand the question a little bit better. So you're saying, so I have a certain asset allocation, right? And every paycheck or every investment that I make is trying to maintain that asset allocation.
Okay.
Is that your question? So for example, if I have, let's say, a 30% US equity, 30% international equity, and 20% bonds, right? So I would keep putting money towards that 30, 20. Does that make sense?
Yes.
Okay.
And do you execute the trades, or do you have your broker do it?
So we'll get to the last slide, which is a financial advisor, right? So I actually have a financial advisor who will do the asset allocation and rebalancing for me.
Okay, thank you.
Mm-hmm. There's something else called lump sum investing, right? So there's something called the time value of money, right? So again, if you look at, well, the market dipped last year, right? Well, if you zoom out, that dip over 30 years is going to be back here, right? And so some people will advocate, instead of dollar cost averaging, just get your money into the market as soon as possible, especially if you have a really long investing horizon, right? So the earlier you get your money in, the faster it can start compounding. Okay, so that's another way of looking at it as well. And finally, in terms of investing behavior, what's your tolerance for a bear market, right? So they say that you don't really know what your risk tolerance is until you see your portfolio losing money. Okay, so in 2008, when the market was down for about 20% for a long period of time, about a year, right? It's painful, right? If you have, let's say, a $2 million portfolio, it's down 20%, right? Actually, at the peak of it, it was down about 30 plus percent, right? So you just lost $600,000, right? So that's a couple of years of income that you just lost in that market, right? And so you don't really know what your risk tolerance is until you endure a bear market or two. And typically bear markets happen, every 7 or 8 years, right? Historically. And that's why people have been clamoring for a bear market, not clamoring, but you get the point. Because after 2008, there really hasn't been a decline in the market, right? And it's been 12 going on 13 years now. And so that's, how do you protect against this, right? So if you have a more conservative asset allocation, as the market is crashing, let's say you are a retiree and you're mostly in fixed income and cash, for example, guess what? Your portfolio is not going to get hit as bad, right? But if you are a young, ultra aggressive investor, you could lose like half of your portfolio. And the key then is, of course, just to keep buying at the bottom and wait, because you shouldn't really be an ultra aggressive investor unless you have a very long time frame that you can weather losing half of your portfolio, right? If that's the amount of risk tolerance that you have. Most people, I would say, have a risk tolerance to lose maybe at your age 20-30%, right? Which is what that market did. Does it make sense? Any questions?
Is there any data on whether it's better to do dollar cost averaging or lump sum investing? Or they're both kind of similar principles where you just stay your money in?
Similar, but I think most people a lot of advisors probably would go towards the time value of money, meaning the faster you get your money into the market, the better off you'll do in the long run, especially over long time frames, right? So like I tend to, like my 401k maxes out at 20,000, right? 19,500. So my first couple of paychecks in the year are very aggressively going straight into my 401k. I get very little post-tax. And so like last year, where, I bought when the Dow Jones was at 29,000. And when it dipped in March, I missed out on buying at that dip, for example, in my 401k. Now I was buying in other taxable accounts and other various accounts that I have, right? But other years, if the market went up 20%, like it did last year, actually, right? Then if you got in January versus if you spread it over the course of the whole year, your overall return might not be 20%. It might be a little bit less. Does that make sense? So if you have spare money sitting around and it's going to earmarked for investing, I wouldn't wait unless you need to have that cushion in your emergency fund or you're saving for something else. I would just put it in, right? And the way I do it is that my paycheck automatically goes towards that savings, right? So I don't even look at it. I don't even think about it. Okay, so how do you do this, right? So you figure out, how much risk tolerance do I have? You guys are young. You have a very long financial career. You've, shored up all of your risk management. You've got all your insurances, etc., right? And so now you have a pretty good probability of earning lots of income for the next, couple of decades. So your risk tolerance is pretty high, right? Because you can weather downturns in the market, bear markets. So you most likely will be more of an aggressive investor, right? Or moderately aggressive investor. And so once you figure out what your risk tolerance is, then you can construct a portfolio with assets that will mimic that risk profile, right? So if you're an aggressive investor, you're going to have more risky assets like equities, right? equities are considered risky assets in essence. If you are a moderate or a conservative investor, you're going to have, less equities and, more fixed income or maybe even cash, right? Then you're going to be, I can't read the bottom of the slide. Fine tune your portfolio, right? So fine tuning in the sense of rebalancing, right? And we'll talk about rebalancing and reviewing your portfolio regularly and making adjustments to make sure that you're meeting your goals, right? And so how do you do this, right? So one general rule of thumb, here. So when we assess risk, the general rule of thumb is age and fixed income, right? So if you're a 30-year-old, and this is debatable, especially now with interest rates being so low. We've never been in this environment of extremely low interest rates and bonds performing as poorly as they are. But typically, the standard teaching is age and fixed income. So if you're a 30-year-old, you're going to have 70% in equities and 30% in fixed income, right? If you're a 60-year-old, you'll have 60% in fixed income and 40% in equities, right? So does that make sense? And so how do you construct this? How did I start out doing this, right? Before I developed a sizable portfolio, as a resident, I was putting into a Roth IRA, I was putting into my 403B at my hospital, and I put it all into a target date fund, right? I put it into a 2040 target date fund. And what a target date fund is, it's basically an index fund that was created by these big brokerages. And what they do is they say, I have a goal to be retired by 2040. At the time, that's what I picked, right? 2040. And so what this will do is it will give you a risk allocation for someone who would retire at 2040. So that's a 30-year. So I started in 2005. So over a 35 year time frame, in the beginning, I'm going to be very aggressive. I'm going to have a lot more equities, right? Age and bonds, right? So I'm going to have a very high amount in equities, but each year I'm getting a little closer to my goal. So I want to reduce my risk because I'm running out of time to accumulate money, right? So if I lose money big time, if there's a big bear market or big crash, then I don't have the time to make it up. Does that make sense? So what this target date fund will do is it will automatically rebalance so that each year, and funds do it quarterly, some do semi-annually, some do annually. Each period, we'll just call it a year, it'll automatically rebalance your portfolio so that as you approach 2040, it will get less riskier, and increase the allocation into fixed income. That's the easiest way you could do this type of index investing, right? Vanguard, all the companies have it. Vanguard, Fidelity, they'll have TD Ameritrade, they'll have a target date fund. And if you just put all of your money into your target date fund, you will ride the market and you will have the risk tolerance that is appropriate for you. Now, if you want to reach financial independence sooner, no, let me rephrase that. If let's say you're a more conservative investor, you're going to pick something like a 2030 fund because that will have more fixed income and less equities. If you are a more aggressive investor, you might pick a 2050 fund because that will have more equities and it will take longer to rebalance to fixed income. So that's a target date fund, right? So that's what in the beginning, that's what I invested in for like the first probably 4 to 5 years of my investing career. I had all my money sitting in target date funds. Any questions about that? Pretty clear, right? How these funds work. And so they created this as investors became more savvy and realized, okay, we need to minimize our expenses. We need to have a high probability funds, high probability index funds that will meet my goals. But we don't want to spend too much time looking at this stuff all the time, right? Not everybody's crazy and attending conferences on this stuff like me. And so that's what this fund was created for. And in the beginning, remember, don't chase rate of return, chase how do I increase my savings rate, right? And if you're just shoveling in money, the target date fund's a great place to park that, right? Now, it's not the ultimate, like if you reach a 10 years into your career, 20 years into your career, you don't want all your money sitting in a target date fund, because it's not, that's when rate of return becomes a very meaningful thing, right? As you have higher and higher net worth and more capital to accumulate. Target date funds won't be, nowadays, they're more expense. They do minimize expenses. They have lower expense ratios as the big brokerages compete for your money, but they're not the most tax efficient because you're holding everything all in one fund, right? So they're going to generate dividends and interest income from bonds, etc. The next kind of fund or portfolio that is pretty popular, if you read all the the various blogosphere, and even there's books written on this stuff, right? It's called a lazy portfolio, right? So Boglehead, so Jack Bogle was so popular. There's actually an entire group of people known as Bogleheads who just preach, the low expense ratio funds that he pioneered. A lazy portfolio might be something like a Vanguard, VT Sachs is a popular one, right? Vanguard Total Stock Fund, right? You can have 60% in VT Sachs. You could have, international, right? VT, I don't remember what it is, but like international, Vanguard International minus US. You could have, 30% of that or 20% or whatever. And you can have a bond fund, Vanguard Bond Fund, and have another 20% in your bonds, right? So that way you have total stock fund, you have international exposure, and you have your fixed income as your base, so that when there's a market downturn, you're not losing all of it, you're only losing some of it, right? So those would be, I think, good starting points as a target date fund or the lazy portfolio. And honestly, you can make your portfolio as complicated as you want it to be. You could have individual stocks. You could open a self-directed brokerage account in your 401k, like we just talked about before, right? But honestly, unless you really enjoy doing that stuff and you have the stomach to weather all of the chaos of the volatility of the stock market, why? Right? You have better things to do with your time, honestly, right? So these are time-tested ways of meeting your financial goals, right? Any questions about this stuff? So we're going to assess risk. We're going to create a risk profile of, am I going to be an aggressive, high-risk investor in the beginning? Probably. And then as you start accumulating more and more capital, you want to sort of dial, ease off the gas and start sort of protecting the gains that you have by switching to moderate risk assessment and then eventually low risk assets. You choose investment classes that you think will meet your financial goals. And you want to do it in such a way that you minimize expenses and you invest in a tax efficient way, right? So the Vanguard Total Stock Fund tends to be pretty tax efficient. So you could put all of that into your taxable brokerage account. You could put your Vanguard Bond Fund, all of that into your 401k. For like the first 5 years as an attending, my 401k, 100% of it went into a bond fund, right? Because I needed to buy bonds and I was limited in how much I could put into my 401k. And so that was how I was able to create the asset allocation that I wanted, right? And then over every, there's a lot of debate of how often you should do this rebalance, right? Rebalancing is important because it preserves your asset allocation and your risk profile, right? So if you have, let's say you're a very aggressive investor. Well, let's say, I'm 41 now, right? So that means I should have about 60% equities and 40% in fixed income, right? Now, last year, the stock market went crazy, right? So now all of a sudden, my equities have become 80% of my portfolio, and my fixed income has become only 20% of my portfolio, right? Just because this grew so much and this was kind of flat. What's the problem here? The problem here is that if I keep letting it ride and I just don't touch it at all, now I've totally changed my risk profile, right? Now my portfolio suddenly has become a lot riskier because I have way more equities than I think I should have. Okay, does that make sense? And so what do I do in this situation? Well, when you rebalance, there's two ways to rebalance, right? So when you're in the accumulation phase, when you're in the early phases of your career, the new money that I'm putting in, I could put more money into my bonds to get it back to 40% and put less money into equities, right? So by doing that, in essence, I'm not buying high, because if the market went up and equities have become 80% of my portfolio, that means the market's at a high, right? And I'm going back to that original risk profile that I had. Okay. So if you have a lot of capital, though, sometimes the new money that you're putting in isn't enough. So you might actually have to sell some of your equities and buy bonds to get back to your risk profile that you are comfortable with. So by doing this, by constantly rebalancing, you're sort of locking in gains. And let's say the opposite happens, right? Let's say there's a big market crash, 2008 happens, right? And now equities have become, 45% of my portfolio, and my fixed income has become 55%, right? Because not because fixed income went up, but because the stock market did poorly and it went way down, and my fixed income was kind of flat or maybe went up slightly, right? Usually it stays flat. Now, to rebalance, I would buy more equities to get back to that 60%. Does this make sense? Okay, I'm going to take that as a yes. So rebalancing is a way to preserve your risk profile. And it's something that you can choose to do as often or as little as you want. Now, by buying a target date fund, they do the rebalancing for you, right? So if there's if the market is doing very well, they're going to either sell some of those equities and buy more fixed income to get back down, or vice versa. If you are going to be more tax efficient and hold your equities in your taxable brokerage account and have your fixed income in your 401k, that's a big deal, right? So by the way, we talked about tax drag. Then you actually can gain like 2 to 3%, maybe even more, on your return if you are investing in a tax efficient manner. But if you're going to do that, then it involves a little bit more work, right? It involves rebalancing and doing that work on your own. And the more complex your portfolio is, the more work it is to maintain it, right? Because if unfortunately, there's very few things, even like a target date fund, that you can just kind of put it in there and then just ignore and come back 20 years later and say, oh, let's see how much money I have now, right? So nowadays, there's a lot of AI and robotics and things like that, which allow you to make it easier, where they do the rebalancing for you for sort of low fees or minimal fees. So that's another option as well. Okay. Before I talk about advisors, any questions about any portfolio construction stuff?
You keep saying that bonds are low right now. So do bonds operate the same value as like buying stocks? Like if you buy bonds low, then like is it good if the value goes up later, or it's like should you only buy bonds when they're high?
No, so bonds are tied closely to interest rates, right? So because interest rates are so low, fixed income, so when I was a new resident, I could open a savings account that was giving 4.5% rate of return, which nowadays is like, wow, that's phenomenal. But now, they're giving 0.6%, right, or less. So, and the bonds, because the interest rates are so low, basically borrowing money is very cheap, right? So that's why bonds are performing poorly, because a bond is basically you loaning money to a government or a company, and they will pay you a certain percentage interest rate back to you, right? Now, if they can just borrow money from banks for very cheap, why would they pay you a higher rate? Right? So bonds are tied to interest rates, and interest rates have been low for the last decade, honestly, since 2008, where interest rates went to basically zero to keep the sort of the equities bubble afloat, right? That's why in 2009 we had a quick recovery, because of the very low interest rates that happened. Does that answer your question?
Yes. So don't buy and sell bonds. Just buy bonds when the interest rates are high.
I wouldn't think of it that way. I would think of it as that bonds or fixed income tends to fluctuate less. You're not going to have a 20% gain or loss in 1 year in your fixed income portion of your portfolio. You might have a 3 or 4% swing in your fixed income.
So the value of the bond can fluctuate that you possess.
Yeah. So, well, what happens is that as interest rates go up, the bond that you have becomes worth less, right? So that's how your bond yield will drop, because instead of, you can buy the higher interest rate bond instead, right?
Right. Okay.
And if interest rates drop, then the value of your bond increases, right? So in 1980, they were issuing bonds that were giving like an 11% rate of return because inflation was so crazy, right? And nowadays, obviously, that's like, you can't get something like that, right? Nobody's going to give you a 30-year bond for an 11% interest rate, right? But for the purpose of the talk, think of fixed income as kind of the stable, less fluctuating portion of your portfolio. So it's kind of the anchor, where you don't want to, if you have all of it in equities and you have, let's say, a pretty high portfolio and you have a short time frame, you only have 10 more years to work, for example, then you can't really stomach a 30 or 40% drop, where the bonds will cushion, the fixed income will cushion that drop. Does that make sense? Okay.
Yes.
And any other questions about portfolio construction?
Okay.
So I think, depending on how good of a job I did explaining portfolio construction, or how bad of a job I did explaining portfolio construction, I think this slide is going to resonate one way or another with you all, right? So, oh my God, what the hell is he talking about? And should I just hire an advisor, right? And so how can an advisor potentially add value to your investing financial career, right? So advisors, you have to be very careful, right? There's a lot of bad advisors out there. The only thing worse than paying for a financial advisor is paying for someone who's going to harm your financial career, right? Who's not going to look out for your best interests. But there are some good advisors out there who can help you, right? And so, what are the things you should consider when you're looking for an advisor? If you need help creating a solid long-term investing plan, right? If you have a set goals that I want to be financially independent in 20 years or 30 years or 14 and a half years, it can be pretty specific, right? And they can help you create that risk profile that we talked about. They can help you figure out what kind of asset allocation based on your risk profile would most likely get you there, to meet your goal, right? If you hire an advisor beyond just writing a there are advisors who will just do a financial plan for you, right? They'll sit down and create this long-term plan for you, and they'll charge a flat fee for that, right? If you want to hire an advisor to continue to manage your accounts, right, so they can handle asset management chores like rebalancing your portfolios, making sure that your asset allocation is on track. They can provide guidance in times of instability, right? If there's, like last year, I bet they were getting a ton of phone calls in March and April when the market was down 20%, right? Like, oh my God, what are we going to do? Is it going to be a big depression? Do we sell everything and just, shift it to fixed income and cash, right? Or do we just, let it ride? And if you had sold at the bottom, you would have missed the huge climb back up over the next, couple of months, right? One of the reasons why I have an advisor is the peace of mind that, there's a second set of eyes looking over my plan, looking over, sort of my asset allocation and making sure that I will be able to reach my goals, right? The last one, which is not a huge deal, is provide access to investment vehicles that are not available to you, right? So there's a particular class of funds called the Dimension funds, DFA funds, which are like these passive funds that have slight sort of algorithmic tweaks that make it, that increase the rate of return on sort of the passive funds. So not a huge deal, again, especially early on, right? Remember, don't chase rate of return. If you're just shoveling in towards your savings rate, that's going to grow your net worth much faster than that little nuance. What are the different types of advisors that are out there, right? So there's 3 types. You know what? I'll start with the worst, right? So commission based, that's the worst. Run away from these people, right? So the only way they'll say, you know what, you don't have to pay me anything. I'm going to create a portfolio for you, and I'm going to have the perfect plan for you. If somebody's working for free, they're either a saint or they're making something off of you, right? And so that's usually commissions. So this is where they sell things like front-loaded funds, where you have to pay money to get your money into the fund, right? So that's kind of like the worst of actively managed funds, right? Those used to be a dime a dozen back in the day, right? But as investors have gotten more savvy, that kind of product has started to disappear as these fund managers have realized they can't get away with that kind of stuff anymore. And almost all the time, they underperform the market, right? Particularly when you take those expenses out. So commission-based advisor is somebody you do not want to deal with, right? So these are also will be advisors that potentially, now not always, but a lot of times they'll be selling you insurance products and things like that, right? Because they will get a big commission. There's a big conflict of interest, right? So their conflict of interest is that, by the way, so there's advisors have something called a fiduciary responsibility, right? So not everyone's a fiduciary advisor. Fiduciary is like kind of like the Hippocratic Oath, right? For physicians, meaning that I'm going to put the client's financial needs ahead of my own needs, my needs to generate income and a profit for myself, right? Now, there's the problem with the fiduciary is that there's not much repercussion for not being a fiduciary, right? In fact, in I think it was 2018, Congress, there was a proposal to basically have all financial advisors be fiduciary and held to a fiduciary standard, right? But of course, it was struck down because of the lobbies that these companies have, right? So that's commission-based, runaway. AUM is kind of a more classic model that's been around for a long time. AUM stands for assets under management. So in the old days, it was 1% and up, right? 1%, 2% of your assets, right? So if you have a $100,000 portfolio, 1%, you're paying $1,000, right? Which doesn't seem like a big deal, but if you have, a $10 million portfolio, 1% is $100,000, right? So that's a huge deal, right? That's a big chunk of money. And so it doesn't, the AUM advisor isn't doing that much more on a $10 million portfolio than they're doing on, honestly, like $1 million portfolio, right? And so AUM is kind of starting to phase out as people have realized that, this is a bit of a ripoff, right? AUM advisors typically will only take high net worth clients to start, because again, if you have $100,000, the $1,000 is not worth it to them, for them to do all of your financial chores and all the time that it takes to invest in your portfolio. And then finally, now there's more and more fee only consultants, right? So fee only consultants are advisors that charge a flat rate. They charge an hourly rate. So if they spend maybe 20 hours in the year working on your portfolio and working on rebalancing, et cetera, then they bill that hourly rate that they have. And this type of advisor will have the least sort of conflict of interest, because whether they just want to give you the advice, and whether the market goes up or down, they still get their flat rate, right? So they're going to just give you what they think is the best for you. So that's the most fiduciary style of fees that can be charged, right? That being said, fee only advisors aren't cheap, right? So when you're first starting out as a resident or a new attending, typically, like to create a written financial plan, they'll charge you anywhere from $2,000 to $4,000, right? And then for ongoing maintenance, they can charge you anywhere from, again, $2,000 to $4,000 per year, right, to maintain your portfolio. So in the beginning, when you don't have much assets, when you're just shoveling money away, you don't really need a fee-only advisor, in my opinion. Now, some could argue that, well, I just want to set up my accounts properly in the beginning and then just let it continue to grow in the way that I want right from the beginning, as opposed to restructuring your accounts once you hit a certain threshold. But honestly, I've already taught you guys over the course of this lecture series the basics of what you need to know to create that portfolio and to get that savings rate and rate of return in the beginning that you need. And the other thing is that fee-only advisors often they'll give you advice, and then it's up to you to execute, right? To do your rebalancing, to put into various accounts. So it requires a little bit more DIY than, let's say, AUM. AUM tend to be kind of full service. So those are kind of the different paradigms. Now, for the most part, I would say for physicians or high net worth individuals, again, finding a good fiduciary fee only consultant would be sort of the way to go in terms of financial advice. Any questions about this? Okay. So, who do I think would benefit from an advisor? You have no desire to learn about any of this stuff I taught you over the last 4 weeks, right? And you want someone to guide you through this process. So people get intimidated by finances, or they're just bored. The very first slide was my daughter falling asleep, right? My wife, I tried to have her sit through my finance talks a couple times, and she's also asleep on the couch next to my daughter. So if you just, then at that point, if you're not going to do any of the legwork, then potentially getting a fee-only advisor is going to actually get you a higher rate of return than just kind of stumbling through the process. You're a super saver. You don't have the time or interest in learning about more advanced investment strategies, particularly like tax efficient allocation is a big deal, right? So we're all in the highest tax bracket as attendings. So if you aren't efficiently managing your investments in a tax efficient way, then potentially you are creating a huge tax drag, because 37% tax on, let's say, a dividend, right, held in the wrong accounts, all of that can add up to about a 2 to 3% higher rate of return over your typical market returns of 6 to 7%. You lack proper investing behavioral control, right? So instead of putting into index funds, you want to buy the hot stock tip with a big chunk of your portfolio. That I would say is lack of proper investing behavioral control, right? If you want to play with 5% of your portfolio, like I said before, that's fine. And finally, you just want a second opinion about your financial plan. You can actually pay advisors a flat rate, right? So you can have someone create a written plan for you and give you sort of the guidelines, the algorithm to proceed. And then you can check in with them every couple of years and just pay them when you need to, when you're, want to make sure that you're on track. Any questions about? I saved the financial advisor bit till the very end, because that's usually like the first thing people ask me, oh, should I just get an advisor, right? But the reason why, I made you go through all of that stuff to learn about, even asset allocation, rebalancing, all of that, because as I said, there's a lot of bad advisors out there, right? And so if you don't have any idea about this stuff, you have no idea if he's, guiding you in the right way. The only thing worse than paying for an advisor is paying for an advisor that gives you terrible advice, right? And so you have to still have some idea and some education about this stuff, because you got to make sure that you're not getting scammed, right? Okay. So no questions about that. So actionable items for part 4, right? Assess your risk tolerance, figure out, how aggressive do I want to be? How much can I stomach potentially losing money? And create an appropriate asset allocation and investment plan based on your risk tolerance. If need be, consider finding a fiduciary fee-only advisor if and when the need arises. Usually, I would say, once your net worth starts getting into 6 figures, might be a good time to consider doing that. Or, if you just want to, like as I said, hire someone or pay the flat fee to get more education, right? Honestly, a lot of this education that I gave you is the same education that they're going to give you in terms of how to create a investment plan, how to have, create an asset allocation that you can live with for, the rest of your financial career. And finally, this is just scratching the surface, right? So just like how you have CME, there's going to be CFE, continuing financial education, right? So if this stuff really interests you, I think I've already recommended a number of different books and sites, right? So a lot of you are familiar with the White Coat Investor at this point, right? So he has done a phenomenal job bringing this financial education to the physician community, and there's a huge forum and community of physicians and advisors who give good advice out there in a consolidated place, whereas before you kind of had to do the due diligence upfront yourself and try to find where the best advice is. So I would encourage you all to continue reading some of these books that I've recommended, reading the blogs if you want to, or there's a ton of physician finance podcasts out there if that's your preferred format, and of course I'm also available as a resource to talk about this stuff. So just to recap real quick, right? So I've given this lecture for a couple of years now, and I found that it's so much information to process, and that's why I've broken it up into 4 parts. Just imagine sitting through all this in one sitting, right? It was kind of like my TE lecture today, right, Marie? So that's why I sort of putting in these action points as well. As residents, what are the things that you can do to sort of get on track, right? So part 1, risk management, just to review, right? For those of you who don't have disability insurance, it's very important to, I think, to get that as soon as possible, right? And we talked a bit about why, right? So lock in your good health. If there's a whole group of you who are interested in getting it, oftentimes there's group discounts. So just email me or text me or whatever, and then we can have someone even come in and talk to you guys in more depth about this stuff. Some of these vetted sort of fiduciary-like insurance salesmen. Secure or adjust your other current insurance. If you have families, term life insurance, I think is super important because they need to be taken care of, right? Establish an appropriate emergency fund. As a resident, plan for that emergency fund to grow as an attending as your expenses grow. Part 2, create a plan to tackle your debt. Make savings automatic, right? So as I said, my paycheck comes to my bank account, and a good chunk of that immediately goes to my investing accounts, right? Analyze your cash flow and automate your financial priorities, and live off the rest. Spend your money in a deliberate, guilt-free manner, which maximizes your happiness. Part 3, right? Identify the type of tax savings accounts you have access to. Maximize those green spaces, right? And structure accounts to minimize taxes during all 3 phases: when you contribute to an investment, as it grows, and as you withdraw. Part 4, right? Assess your risk tolerance and create an appropriate asset allocation investment plan. Try to find an advisor if you feel the need for it. If you, again, don't want to put in the time to learn this. The thing is, this stuff seems very complicated, but all the education is up front. During the maintenance phase of your financial career, it's actually very little sort of continuing knowledge or work or studying to learn this. Once you learn the basics of this stuff, it's actually not that much work. So, and I've probably taken you a big step forward in that direction just with these talks alone. And then continue your financial education. If you want to go down the route, there's plenty of residents that I've talked to who are DIY, do-it-yourself investors, and they kind of read about this stuff on the side. There's some residents who teach me like sort of new techniques and tools and things. So I'm still also continuing my own financial education. And I'm going to end on this slide, which is for those of you who want an algorithm, right? So I have X amount of dollars. Where does it all go, right? Or X amount of time and interest. And what do I focus my priorities on? Start number 1, well, right at the very top, right? Disability insurance. Once again, life insurance. Get your insurances out of the way, right? Lay that foundation. Create your emergency fund. Tackle your debt. Start saving. Get the match for sure. Pay down high interest debt. Financial education, right? See, that comes before 401ks and HSAs, right? So put in that upfront effort to learn this, like the basics of this stuff at least. Then continue contributing to your tax efficient accounts like your HSA, your Roth IRA, more into 401k. And then finally, pay down your loans, your house, low interest debt, and investing in a taxable brokerage account. After you've done this stuff, live off the rest. Spend it however you want. Questions? You are stunned by how clear and concise I was, or overwhelmed by everything I presented. Okay, so you guys all know how to reach me, and I love talking about this stuff, obviously. So feel free to reach out anytime.
Thank you.
Thank you.
Thank you.
Sure, you're welcome.